All right. Good morning. Good morning, everybody. My name is Francesca Carrieri. I'm here to welcome everybody to this webinar that has been organized by the McGill Alumni. We are here ready with Jordan Waxman, our guest today. In the meantime, while we all get settled, we think it's going to be a great way to start. We actually have prepared a poll for everyone to feel as we, get comfortable on our chairs and stuff. And I think this is going to be a good way for us to start our conversation. So we can start with the poll. We're going to leave it there for a little bit. And if you can please let us know what you think about how concerned are you with how to speak to your children or grandchildren about money, and please select one. So while you guys think about filling out the poll, I think it would be nice for me to introduce myself a little bit, let you know a little bit more about myself. I'm an associate professor of finance at McGill at the Desautels Faculty of Management. My research interest is in international investment. And so I look at things like exchange rate or benefit of international diversifications or emerging markets, things like that. I have published in research outlets, top research outlets like the Review of Financial Studies, for example. And I also, nice thing I did for McGill, I organized the 30th meetings of the Northern Finance Association. Northern Finance Association is the top academic finance association in Canada. And we every year we have a conference around September. It's actually coming up. Of course, this year is going to be virtual, like all the big academic conferences we had this summer. And it's one of the top 5 around the world. So that's about myself. Oh, I can't really see. Okay, here we go. Oh, we have the results of our chat. Well, we're going to start with that when we start our conversation, but I think what we need to do, first of all, is to introduce our speaker first. And then I'm going to get to that. Okay, so we're so thrilled today to have Jordan Waxman as our guest. Jordan is the managing partner of Nucleus Advisors, a private wealth planning and management firm. He also serves as the board of director of Hightower Advisor, registered investment advisory firm. Now, Jordan had long experience in investments. He was the senior vice president of investments at Merrill Lynch. And before that, he was the vice president at Goldman Sachs. What is nice for us is that he has helped McGill a lot. He's involved in all sorts of things, highly engaged. He's the president of Friends of McGill. He's the member of the McGill Law Faculty Advisory Board. He also helps with the regional advisory board in the US, the East Coast, and also has helped as a lecturer at McGill. So there's a long history, of course, of alumni volunteering and being engaged with McGill in the US. So this is an example, right? So we have all you guys here with us. I'm sure I have some of my previous students logged in, which is very exciting. So we have all the McGill alumni, and this event is sponsored by the New York Finance Group. And so those of you who are interested in joining the Finance Group will receive after an email from the Advancement Office. And there's some requirements. You have to have at least 10 years of experience. You're going to have to be asked to participate to our event, hopefully also in person very soon. And of course, you have to help out in the network that we have with respect to job shadowing and mentoring all the members. Okay, so I think the best thing is to start right now. Hello, Jordan, how are you?
I'm well. How are you? Nice to see you again.
Nice to see you again, definitely. Everything is good over there?
Yes, I'm in very hot southern Florida right now. Summertime, it's summer all year round here, but summer in Florida is especially hot. But I hope
Well,
everyone's well. I hope you're well and all your families are well.
we hope that everybody's well and everybody's family is well, definitely. And we're starting another important stage of this, I would say, this pandemic. Anyway, so when we decided to get together, we thought about how this was a great way to start, right? How to speak to your kids about money. And so the question is, how do people have to be concerned about multi-generational wealth and how to transfer that in the best and most effective way? And so, Jordan, you are an expert on this. So I'm curious to hear what you think.
I am the last year of the baby boomers, and if you listen to my children speak, who are 18 and 20 and 21, they say, your generation ruined it for us. You tried too hard, you achieved too much, and you made it very difficult for us. And so Gen X and millennials and Gen Z and so on, they have a perspective on wealth that's very different from ours. Their expectations are different. I think they're I'll just take my case for example. I had to pay for college, and I had to pay for law school and business school. And so when I was at McGill, I worked 4 jobs. So I worked 4 nights a week and was on the swim team and did all these other things to get the really great college experience. And McGill was $900 a year. So it cost more for living expenses than it did for tuition at the time. And now I have 3 kids. They're all in private colleges, and I'm paying for all of that private school. So there's a very different, a shift of mindset about what was expected of me anyway. I can't speak for the people on the call, but in my case, and in the case of my clients who are ultra affluent clients, they are definitely, in most cases, wealthier than their children are and expect to be. Same thing with grandchildren. And so in the world, there's an expression in pretty much every culture in the world, which is shirt sleeves to shirt sleeves in 3 generations. So many stories of the patriarch or matriarch building a company and putting all of their sweat into the equity of the company and building this big institution. And then the children, if they don't share the values and they don't share a common mission statement and shared meaning around what the wealth actually expresses in terms of social capital and obviously financial capital and opportunity and responsibility and stewardship that goes hand in hand, then the second generation tends to squander it and it's really gone by the third generation. And so I spend a fair bit of time with clients in building a common mission statement. It takes 5 years to plan for the next 50, but the families that are really successful at delivering results there and building stewardship in their families are able to transmit the values across multiple generations.
So if I can interject here, one of the questions we got is like, okay, now we are in 2020, we went through all this, and what would you recommend also to young people who are just now, right, starting to earn money? Maybe hopefully the class of 2020 got jobs, or they're going to get jobs very soon. What is your advice, right, when it comes to also financial literacy? That's something actually we're very concerned at Desautels, and we want to push. So what's your advice for the young generation besides the transfer of wealth?
Well,
we
so
just start
I'll take
now.
2 different questions. One is, how do young people get financially literate? And the second is, when should they start planning for their own future? So I view these 2 sort of, symbiotic. And so on the first one, when we were young, building financial literacy was done through what I would call folklore. So listen to grandpa talk about his experience. So my grandfather came to Canada when he was 9 and started from Poland and started sweeping the floors of a dress factory, and then somehow stayed long enough and learned enough to then buy into the dress company, and then he bought the building, and then he bought another building, and there you go. He built his empire. I did it from nothing, never went to school, did it from sweeping the floors. And so that's what I call folklore. That's the values that he espoused. And, unfortunately, he loomed very large over his family, who didn't really ever become business literate. And so it skipped a generation. It wasn't necessarily all that helpful to my father, for example. But when our generation wanted to be financially literate, when I was at McGill Law School, I was one of two students who stood in line for the two copies of the New York Times that we got at the kiosk every morning. My friend Phil Lieberman and I. He ended up being a mergers and acquisitions lawyer and then a banker, and now he's in private wealth management. And I went just right into private wealth management, but I was interested in becoming a white-collar criminal prosecutor. Manuel Noriega was going to jail for tax evasion, and I was really interested in that. And he was interested in KKR Nabisco leveraged buyout. But in any case, we ended up sort of overlapping and reading quite a bit about business and getting sensitized about it. And I went on to business school at University of Chicago. The rest is history for me. Becoming financially literate was self-driven, some folklore, but really self-driven. I have to go out and search for the information, and it was in the newspaper, right? The Wall Street Journal, New York Times, Warren Buffett books, One Up on Wall Street, so stories about investing and things like that. You have to become current as you go up. Today, all you need is your phone, and the information is pushed every morning. So you can become financially, if you're interested in it, you become financially literate very quickly. So my 18-year-old, who's a freshman at college, he asked me, how do I become financially literate, other than all of the time I spent with him talking about investments and his portfolio and why and what they're for. And but in terms of how to set a budget, how to start investing on your own, when do you start saving, things like that you talked about. The second question, I had him sign up for a subscription to the Wall Street Journal, and I told him which sections to read, and we discuss it on a weekly basis. And so you have to build that. A good friend of mine, Paul Pagnato, is teaching at various universities and building financial literacy into university programs, which I think Desautels should do more of.
Right.
Budget.
We're looking.
I wouldn't assume that everybody's going to get it out of an investments course that's really more focused on statistics than it is really on the nuts and bolts of keeping literate. And to the second point about when should young people start investing, young people should start doing two things as soon as they get out of college or even in college. One is saving. There are four ways to really do something with your money, right? So saving, spending, investing, and giving it away. So I'd say, obviously, saving money is important. So you look at what's my student debt load, what do I need to pay for that, and all my expenses around living. How much is the bank of mom and dad kicking into that conversation, if at all? And the rest is saving. Spending, there's only so many avocado toasts that you can buy before you should really be making them at home, right? That's kind of expensive. But the other two things that I think are more important are the investing and giving away. So every time I taught at McGill, I encouraged the students while they were at McGill, and as soon as they graduate, even if it's $5, give back to your alma mater. Give back to McGill, $5, $25, $100. Keep a regular cadence and lean in and figure out how valuable that was to you. And I host a party, like a cocktail party for the law faculty in New York every year. And I tell the same story. I was at McGill for 9 years. It was $900 a year. I got a huge return on my $8,100 investment. And so I'll spend the rest of my days trying to figure out ways to give it back in a sustainable way to McGill and to other causes where I feel really passionate about. And so that conversation about giving it away rather than receiving it, I think is important. So
Very
even
nice.
people on this call, so one of the things I talk to clients about is if you want to talk to your kids about money and you don't want to talk to them about receiving money, then at Thanksgiving this year or Christmas or whatever holiday, and you have the kids together, give them a challenge. Say, okay, mommy and I are going to give, or I'm going to give, or mommy's going to give a certain amount to each child to give away to the charities of their choosing, and put whatever constraints around that you want. Like you have to actually pitch the family on them. They have to be 501c3 charities. And what I do in addition is I get my kids to work together. If they collaborate on a gift, they get 2x the amount of money to give away. So instead of $250, if two of them work together, it's 500. If three of them work together, it's 750, and to that cause. So it builds teamwork as well. So there are all kinds of tools and rules you can build into your own family life that become really driven around literacy, around stewardship.
Oh my God, that's so nice. Such great ideas. That's so awesome. All right, so let's say you starting, okay, either, you start earning money. So, and Jordan, you of course manage a lot of money for big, very wealthy clients. But how would you start thinking about, putting together? What can you say when you're starting on a smaller scale?
Well, lucky now, technology has become so disruptive. When I got out of college, it was 1986. I think you had to actually buy a physical share of stock if you wanted to buy stocks. It was sort of, and the spreads on the shares were large. And now you have things like Robinhood and other technology that make it, or even Schwab, or Fidelity, that make it like almost costless and seamless to set up an account to buy either shares of stock if you want to, partial shares of stock, which never existed before.
Now, yes.
And there's no real transaction cost for it. So there's, in a way, really no excuse. And at the end of the day, we have to look at, I mean, the simplest way to do it for young people is to say, you probably want to save this. You have a very long road ahead of you if you're going to be an investor. So, take some risk, find out the companies that mean something to you, that you use all the time, that have a sustainable business, that have the kind of practices from a corporate governance perspective, or socially responsible, whatever filters you want to lay on to your investment process, and buy shares in those companies, and lean in and figure out what makes them tick and why they're trading the way they're trading and what value they have and so on. And of all of the things that you look at when you're investing, if you're overpaying for something and it's a well-run company with a defensible business strategy and a defensible moat around its business, then it's okay to overpay, because time will effectively cure the excess cost that you pay. That's an old, time-tested mantra that, if you buy good quality companies and you hold them for the long term and you buy them at attractive prices, you should make decent money in the stock market. And of those variables, the attractive prices, is the most relative term. Look at the video conferencing stocks and how they're trading, and some of them, yesterday there was one that was up 40% today, $35-40 billion of appreciation in one earnings report. But why is that? I mean, and is that telling you where it is today, or is that telling you where it's going to be in a year or 2 years or 3 years? So there's really, there's a lot to learn about investing through the stock market, but more important than that is pick your time horizon, pick the companies that are going to flourish, that have good managements, and then just buy shares of those.
And then go with it. Yeah, so actually the technology is really disrupting everything, right? And so definitely investment, for the retail investment, for sure, right? So, and how has it impacted more directly maybe your business? Or what would you say it's been really changed in the way you run your business?
Yes, so there's two ways to look at it. One is, how is disruptive technology opening up the field of investable solutions for clients, right? So just never mind how I'm using those tools, but looking at fintech and looking at disruptive technologies and so on, how does that open up a new area? So for example, let's say you've been passively invested in, and a good part of the market's been passively invested for 9 out of the past 10 years. Well, if technology is becoming so disruptive, do you actually tilt your portfolio or lean into those solutions that, let's say, will benefit from work from home, that are more about disruptive technologies, that are more about digital communications with people? So that is one way to look at it, is saying, well, we can't ignore this anymore. We really have to find out where this is going. So when I got out of business school in 1994, technology was probably, 14% of the stock market. and now it's 2.5 times that. It's almost 40% of the stock market. Back in the day, all the money was in the hands of financial services companies, which is why I started working at Goldman Sachs and not Apple, or Amazon or Google. And now financial services is a very small part of the market. Energy is 3% of the market. I think it was up to 30% at one time. So, you can't ignore that from an investment point of view. The second question I think you're asking is, how does disruptive technology help a private wealth management business? And that's a very interesting question, because we rely on technology for many things in our practice. We're an independent investment advisory practice that uses performance reporting software. We use security software. We use asset allocation methods and software for that, financial planning software. So we use technology solutions that are becoming more and more creative and specific. Customer resource management, like Salesforce, is a big part of our practice. They're becoming more and more interesting, influential, and so on. So, we don't keep calendars on paper anymore, right? When we're setting up the Zoom call with somebody or this GoToMeeting call, we send out a meeting reminder over Microsoft Outlook or Google Calendars or whatever it is, and it's there and it tells us when we need to be. There are reminders that are set up. There's instant access. So, we're really reliant on technology to run our business. On the investment side specifically, are we using a robo-advisor solution to pick exchange-traded funds or stocks or anything like that? We are not. Doesn't mean it's not a good solution. We just feel from our chief investment officer standpoint, given our 25 to 35 years of investing history, we kind of know what we want to own. We know why we want to own it. We have a point of view about that. But we use technology to inform us, and if there is a solution, we're agnostic. We'll use it. Where the sort of special sauce of our business is, I don't believe, is on picking, value over growth or size over large cap over small cap and so on. That's a part of it that drives some excess investment returns. But the reason that clients want a relationship with Nucleus Advisors or with me is because there's a sophisticated advisory solution that is really tailored to them, that helps really drive impact. So we impact on tax mitigation, on estate planning, tax planning, jurisdictional planning, all kinds of things that my McGill law background, in addition to the MBA, are both equally helpful. In addition, when I was an undergrad at McGill, I studied liberal arts. I was a humanistic studies major. I don't even know if that still exists, but it gives you a perspective on everything from language. I had to study Italian for 4 years, which is why you and I can communicate so well off camera, and art history and statistics and history and political science and psychology and so on. And that is what I draw upon to create a relationship with the people that I'm with. We are in the connections business. So in our business, I think clients want to be in a relationship with someone that they like, they trust, someone that can make an impact on their lives and in the lives of their families. And so anybody who doesn't have that experience, I think, is missing out on an important, an important relationship in their lives, professional lives, personal lives. And the more wealth you have, the more complicated it gets, and the more important the impact becomes. Tax laws change all the time, investment rules change, opportunities change. This is a year of massive upheaval in the markets, where you had a 30 to 40% correction in the markets and a 60% rally, after that. And, if you weren't dynamic in your process and you weren't leaning into these trends, then you missed out on quite a bit.
Yeah, for sure. Because you touched on the tax and the risk management and so on, we actually had prepared another poll question. That maybe would be a nice time to bring, maybe who's behind the scenes here, who's helping us, would like to launch that, and our participants can go ahead and fill that. At the same time, I thought I was going to say a little something about the technology. Yesterday was a crazy day for Zoom, right? So actually today is the day McGill starts classes. It's our first day of our class starting again. maybe it's not surprised to say that nothing is normal. So all our alumni maybe are wondering what's McGill doing. And so what we decided to do is to have a hybrid model, to follow a hybrid model. So some classes, small classes, like the seminar style, when you only have a limited number of students in class, will be in-person teaching. But most of the other classes, and especially of course, the large-scale undergraduates and all that, is going to have to be by remote delivery. And so I can tell everybody, people think professors during the summer, they're just on a beach, and that's it. That's all we do. But actually, besides the fact that we also do research during the summer, this summer was so busy because we had all these, seminars and how to learn and all that. So that has been a very busy summer. So we think we're ready. We're starting today with remote delivery, and so we'll see. So that's how technology has impacted us.
Okay, let me point on that, because if you're studying math or psychology or humanities, learning remotely, as challenging as it is possible. But what if you have to be in a science lab, right? What if you're in physiology, anatomy, chemistry, medicine? Then you kind of have to figure out a way to be in the lab. It's a hands-on discipline. So it's interesting, a couple of years ago, I used to travel up until COVID, 200,000 miles a year. And on one of my flights, I was next to the dean of the law school at University of Miami. And I've always wanted to go back to school, believe it or not. I believe in lifelong learning, and I'm never really satisfied, and I always want to build preeminence in my practice. And so I asked the dean about the LLM program at University of Miami. I had just moved to Florida and so on, and now my daughter's a sophomore there. And he said, oh, yes, we'd love to have you. And I said, great, can I do it remotely? And he said, absolutely not. So 2 years later, about 6 months ago, I said, hi, remember me? He said, sure, of course. I said, will you still have me? He says, sure. I said, can I do it remotely? He says, you don't have a choice. So I'm an LLM student. Okay, I'm at least twice as old as the next oldest student in the LLM program in entertainment, arts, and sports law, because we have quite a substantial sports and entertainment practice, and especially around tax mitigation and planning for them. And so I'm back at school, and 4 days a week, it's classes and all the other asynchronous classes that you listen in on videos. And 1 day a week, I'm on campus for an in-person class. And in January, I expect to be 5 days a week, in person.
Yeah, well, for now, McGill also is only talking about what to do in the fall, and we'll see what happens, right? So I don't know if everything went through with the tax planning poll.
I didn't see a poll on my screen, but that doesn't mean it wasn't on.
I didn't see a poll on my screen either, so I don't know if they let us know. Yes, here we go. Okay, so this is the poll we had thought about, because we were talking about taxes and so on. So how concerned are you about taxes? And we would like to hear from our participants, and maybe then Jordan can share a little bit of his wisdom. Well, okay, are we going to leave it on for a little bit? Okay, so why don't we, maybe before going back to the tax things, why don't we continue talking a little bit about this crazy market? I'm going to give you a question, which is also motivated by my own personal interest, but I know also was part of the question submitted. What's your outlook on the Canadian dollar exchange rate? The US dollar, I'm following that closely. I bring it up, of course, in my classes, as going through quite a change, right? It was, as a safe haven currency, was shut up a lot in March. And ever since, I started declining. Now it's 10%. And our trade weighted base is lower. What do you think specifically for the Canadian dollar versus the US dollar? Just your general view.
That's a great question. Yes, Professor, I'll do my best.
Yeah. Very self-interesting. I said that.
school, my favorite, I studied economics and finance. And so what they taught us in macroeconomics was that interest rate differentials really track your expected differentials in interest rates. So what drives interest rates is inflationary expectations, and what drives inflationary expectations is supply and demand of goods and services and so on. I mean, like, you basically take the argument down to its, now there's that, which is always at play. But to me, I think the bigger issue is we are in a time of unprecedented stimulus. I thought after 2009, when all the central banks coordinated a response to the credit crisis, that, you know, everyone's chips were in the middle of the table, and it was a reasonably coordinated. It took a while to get everything together, but it reasonably coordinated because the financial system globally was so tied together, and everybody had to re-stimulate. Now, what you're seeing with a public health crisis is a little bit different. Yes, everyone is affected, and yes, there are different spikes in contagion, and there's a race towards vaccines and so on, but it definitely hit different countries differently. The response was not at all uniform. And so in the case of the United States, in an election year, the United States has basically telegraphed that they will stimulate to the tune of 30% of the GDP. So when you're looking at just the supply and demand of US dollars, and you're about to flood the market with something, it doesn't matter what it is. You flood the market with lobsters, or you flood the market with US dollars, or you flood the market with Dell computers, the price goes down. It is just an oversupply. And so if other investors are looking at the US dollar as a reserve currency and saying, well, it's just in abundance, why don't we take the scarce good over the abundant good? Just from that perspective alone, you could see why the United States has, in printing so much money, is creating budget deficits, which create downstream inflationary effects eventually, or worse, deflationary and stagflationary effects. So in other words, global investors are looking at the US and saying, I'm not so sure, even with a 0.67% on the 10-year treasury, that that's a good bet for me. I think that the currency is actually going to be devalued. And so what you've seen is a coordinated bet against the US dollar. The Europeans have stimulated, but not to any degree. I mean, the single digits of GDP. And so the euro is starting to strengthen. It's stalled today, but it could very well, you know, go to 125 against the US dollar. Canadian dollar has had since the lows of March, has gone steadily up to 77 cents. It is an inflection point. It's a resistance level. But, you know, I would not be surprised. Again, a lot depends on the risk on appetite in the equity market, because if you're risk on, then you don't need to hold US dollars. So you don't need a safe currency or Japanese yen. So, you know, it's okay to keep going, for example. The price of oil has seemed to have caught a bid. So you know, in the sort of mid 30s on West Texas Intermediate oil, which is supportive of the Canadian dollar as well. Price of gold is obviously high. That's usually supportive of the Canadian dollar because it's a natural resource-based economy. You know, so all those things sort of point to what I'd call continued weakness in the U.S. dollar. I mean, my personal opinion, based on all of what I just said, is, and it's Nucleus Advisors' point of view, is that the weak dollar is going to be here for a while. It will be not just a flash in the pan, but it will be a cycle of weak dollar, which actually, from a geopolitical perspective and a policy perspective, supportive of the U.S. trying to get more export-driven business anyway. But I don't think the government's going to come out and say we want a weak dollar. But we've seen times in history when they've supported a weak dollar. Back in the 1990s, when Bob Rubin was the Treasury Secretary, they definitely supported it.
Right?
They won't see it because it's. I don't think voters understand that. Wait a minute, let me get this straight. You want to weaken the dollar? I don't understand. I thought we were at war with, you know, China, for example. So
yeah.
Anyway, so that, I think, is the view on the U.S. dollar, which obviously, and the market, which obviously have spillover effects to the Canadian dollar.
Yeah.
And you asked me offline, like, well, what about this crazy stock market? Do you think it keeps going on and so on? And you know, you tell me what the alternative is. what's the alternative to stocks? Is it bonds, which have negative real interest rates all over the world, and in some cases negative nominal interest rates? Like, I don't see that as that just seems like a sort of a more fool me type of investment. There are places for bonds in people's portfolios to maintain the principal, but not when you're paying the government to hold your money. Now, that doesn't make any sense. And so you have negative real interest rates across the globe, so bonds don't really seem attractive. Cash is back to zero. That doesn't really seem attractive. We have, at Nucleus Advisors, we have 30% of our portfolios in alternative investments, venture capital, private equity, some credit.
How about real estate? I mean, that's an interesting thing, right? That's going on. So we're seeing maybe the real estate investment, the residential versus the commercial, right, type of real estate investment. What's your view about what's going on there? That's alternative, so maybe.
It is a quagmire. I mean, just I think take a like a plain vanilla point of view and everyone should just call their friends at other firms and say, are you guys taking more commercial real estate because you need to be more set apart from one another? Or is your company saying we're going to be really flexible about work from home and we'll probably take less commercial real estate than before? So in my sort of experience in looking around at our company and what our needs are and so on, there's going to be more flexible work habits and less need for expensive commercial real estate. And so I think that is a problem. Where we're investing in real estate is in last mile delivery of online retailers. What they need is they need distribution space. So they need warehouse space within 5 miles of a city center. And so we've invested in a fund that actually takes decommissioned power plants and remediates them from an environmental point of view and turns them into commercial real estate so that they can lease them out to the last mile distributors for online retailing. And that's been a fantastic business. But the same firm which can go into commercial real estate or residential real estate really hasn't made any of those investments other than developments around city centers that are just undeveloped land. Other than that, really, I don't think now's the time for that. And if you look at what's happening just in New York real estate, it's the same as most city centers. Is the suburbs are booming. People want to move out of the city centers. I have a friend who said, I called him yesterday. He's a real estate attorney in upstate New York, and he says, I track my 2-week busy schedule and closings going back 25 years since I became a lawyer. I've had the busiest 2-week segment in my history, and I'm in a closing and someone calls and they want to hire me to do another closing. So I think that's just an anecdote, but I think that means that people are moving from city centers. They don't want to commute in. The pandemic is not only a fear about today, it's a fear about a lack of preparation for municipal governments and counties.
For sure. Yeah, very interesting.
Happen once, it can happen again.
So we're getting closer to the end. Maybe we can look at whether or not people are concerned about taxes. Quite a bit.
This is a little different. So, I don't know if everyone can see this, but 83% of the respondents said that they're either quite a bit concerned about taxes or somewhat. And so I want to talk to that for a minute. So obviously we had some tax changes in I'll just talk about the United States because I think most people logging in are in the US, but nevertheless, tax rates declined, nominal tax rates declined for the average taxpayer at the federal level a few years ago, 3 years ago. And that's great, and that would have been fine if that were the whole story. However, the federal government said we are going to change the exemptions. We'll bump them up a little bit, but the major exemption for most people in New York, New Jersey, Pennsylvania, Illinois, California, some of the higher tax states, was that they were able to deduct their state and local income taxes against their federal. And when that went away, instead of getting a tax cut, most people got a tax hike, substantial. So that's a major issue. And whether or not you have a change from Republican to Democrat in the White House next year, there's only so big a hole you can dig from a fiscal perspective. The tax revenues are down, and incomes are down, and spending is off the charts. So there's that ratio has to change at some point. Otherwise, that will impact the credit rating of the United States, even though the United States can print money, and that's the sound you're hearing in the background is those printing presses, day and night. But aside from the fact they can print money and it's a reserve currency, that doesn't always have to be the case. There's if Japan and European Union and Bitcoin and gold, become more of a standard, even non-Japan Asia, you could see potentially some of that bloom come off the roads in the United States, and then you got bigger problems. Then the cost of debt becomes a big problem, and you no longer have a revenue perspective problem. You have a spending problem. The cost of servicing the debt goes way up. So, so what does that mean? It means for the average taxpayer, they should expect to see higher income tax rates, either at the state level, at the federal level, or both, or potentially, I think if a Democrat comes in the White House, it's very conceivable that they will roll back the state and local exemption that they got rid of, but not 100%, because they still need some there. So I think from an income tax perspective, I don't think it gets any better than where it could get worse. And for if you're running a corporation, corporate taxes as low as they are probably don't last forever. Capital gains taxes as low as they are, even though they've come up a little bit, probably don't remain as low as they are forever. So I think the expectation is that you probably have some higher taxes on the income tax rate, capital gains tax rate. So you have to find ways to mitigate that. That's one thing. The estate tax exemption in the United States is larger than it's ever been. So a couple can exempt $23 million from their estate today or at death, but those rules will change either by statute in 5 years. They will sunset, and then those will get cut in half again. Or you could definitely see a Democrat in the White House saying, why are we giving such an enormous exemption? It really doesn't help the average American taxpayer. So if we just take that away from an estate planning point of view, it's not a huge amount of revenues, but it definitely tells the public that you're interested in their perspective and not just the wealthiest of the
Right.
So tax mitigation, estate planning, tax planning, they are currently very important. And I think between now and the end of the year, as busy as we've been around tax mitigation, I suspect it will get even more so. And then come January, you're going to see what is going to be in effect for 2021. And then you won't have time to adjust because all of those rules are normally retroactive to the beginning of the year.
Right. Great. Thank you so much for all your knowledge, really. And for sure, everything is just so uncertain, right now. And on top of that, the political uncertainty, and as you said, that's going to impact maybe the tax policy and the budgets and everything seems to be so connected right now.
Yes.
So thank you very much. We are at the end of our 45 minutes together. This has been a very enlightening conversation. Thank you, Jordan. This has been wonderful. And when I say goodbye, I also have to remind all our participants that they will receive an email from the Advancement Office at McGill to remind them that we have this great group that does great thing in the New York area, and the people like Jordan are, helping out. So we're looking forward to hopefully see each other in person. And we thank Jordan again. It was fun. Thank you so much. And I want to say goodbye. I want to say ciao. Arrivederci, right? Arrivederci to everyone.